Good morning. Great to see so many of you here today. I'm JP Hamang with IHS. And as always, the material I'm going to show you today, I can't take credit for it. It's been put together by a number of our teams at IHS who are experts in their particular fields. So in this environment of uncertainty, we have called this presentation Keep Calm and Carry On. Many of you may know us as IHS. Others may know us from some of the companies that we brought together over the last decade. Myself, I came from what we called ODS Petrodata at that time. We also have brought together companies like Global Insights, Sera, PFC, Purvis and Goetz, to name a few. We provide information analytics and expertise to capital-intensive industries like automotive, defense, aerospace, maritime, and energy, which I'm part of, together with 2,000 other professionals, providing insights and support to our clients making decisions along the value chain on a daily basis. At IHS Energy, we also focus on the oil and gas service sector, which we're going to present on today. And we do track and forecast demand, supply, the vendors, capacity in the market, and costs, to name a few. FPSOs and floating LNG and FPUs are among the categories that we track. And also we do track capital equipment, installation, and services. So with that, to the agenda. When Joshua contacted me in the middle of last year, we talked about presenting on the outlook for the FPSO market. But as things have changed quite drastically since then, we agreed that we're going to start off with looking at oil price forecasts. So it's been mentioned a couple of times already, and I'm not going to give you an answer for what it's going to look like over the next 5 to 10 years, but we're going to talk about some of the fundamentals behind it and why we're ended up where we are today, and maybe some insights into what's driving it over the next couple of years. So let's start off with looking at why we ended up where we are. So not surprisingly, it is a matter of supply and demand imbalance. In 2014, we added almost 2 million barrels of oil per day in new supply capacity. On the other side, on the demand side, it merely increased by 900,000 barrels of oil per day. So there's a huge gap there. And this divergence was mainly driven by structural changes. So on the supply side, we have the US shale revolution, of course, the biggest driver. But also we have growth from other frontiers like Canada, Brazil, US Gulf of Mexico, Saudi Arabia, Russia. And then on the demand side, we had structural issues like a slowdown in the demand from one of the main growth countries, China, but also structure changes like subsidy reforms, fuel switching, and also other emerging countries slowing down. So we predicted a downward pressure on oil prices already 2 years ago. However, I don't think anyone predicted the reaction, the significance of the reaction that we saw in the market. The biggest source of new supply in 2014 came from the US and US crude production. Crude production grew by 1.2 million barrels of oil per day net alone from the US. So that had pretty big impact on oil markets. And to put it simply, the US growth alone could make up for the demand growth last year, right? So, looking at oil prices forward going, we do expect that there's going to be pressure on oil prices in the next couple of years, and we will not see $70 in the next 2 years. We do expect that oil prices are going to pick up towards the end of this year. However, it's not going to reach the $100 mark in the short to medium term. So let's look at a few of the assumptions for why we think this is the scenario. Let's start off with US production. So, of course, there's been a revolution in the US on the technology side, allowing us to produce oil from shale. However, with the current oil price environment, production from the US is going to go down. That's a certain. We did a painstaking well-by-well analysis, which resulted in this chart. We see the break-even prices from the wells drilled in 2014 onshore US. And what you see here is that less than half of the wells drilled last year is economical at $60 a barrel, right? So this will have impact on oil production from the US in the coming years. What you will see over time is that technology here is going to improve and also costs are going to go down. So there will be a shift in this picture over time, but in the short term, we will see slowdown in growth from the US. And we're already seeing this in the latest drilling activity figures from Baker Hughes. This latest showed a 25% drop in drilling activity onshore US over the last few months. So that's a early warning signal for what is going to happen in the US. So, of course, the production in the US is much quicker to react to changes in oil prices than conventional developments, and especially offshore developments, which have a kind of pretty long lead time. So compared to an offshore development, you can sort of switch it on and off, but we're still talking about months in terms of reacting to changes in the market. Now, US production is not the only important mechanism when looking at oil prices. Looking at conventional developments, if you look at a $60 a barrel break even, you will see that a lot of projects will be at risk. So here we have plotted high, average, and low prices for different countries and different type of developments. And you will see at $60 for a number of countries like Norway, UK, US Gulf of Mexico, Angola, Nigeria, a number of the projects will not be profitable and will be at risk, either be delayed or even cancelled. There's typically a 2-year lag from when we start to see the full effect of a lower oil price environment of this type of developments, as projects that's already been sanctioned, especially for offshore, take some time to filter through, and it keeps adding additional volume. But we've definitely seen a slowdown in activity in the market, and that will have effect eventually. Looking at feed activity, we already see this slowdown started a year ago or so. Feed activity dropped significantly in 2013 and 14. And furthermore, we do expect that OPEC will maintain its current position, which is going to have a downward pressure on oil prices. While on the positive side, our economists, they expect a continuous gradual growth in the demand side. So we had 900,000 barrels of oil increase in demand last year. We expect about 1 million this year and 1.2 next year. So a gradual increase on that side. Now, with this in mind, we have a 5% annual decline rate globally. So this is 5% that needs to be replaced every year. Also, if you remember, half of the wells that was drilled last year was not economical at $60 a barrel, right, from the US. And also we have conventional developments being at risk in the current environment. So it is our belief that oil prices in the longer term needs to find a balance at a higher level than what we are today. It's not sustainable at the level we see today. But in the meantime, waiting for this to happen, there's going to be a number of short-term risks, which is going to drive volatility on oil prices. On the upside, there could be a new collapse in Libyan production. We see a lot of uncertainty in that country right now. Also, we could have supply outages from countries like Venezuela. On the downside, we could see additional volume come in from Iraq and even Libya. And we could see weaker demand growth in Asia Pacific in particular. Also, there's a lot of talk about storage these days, and that's typically influencing short-term pricing on oil. So in the short term, there will be high volatility, and also this is being fueled by some of the paper trading that we see in the market. Now, another thing that will need to happen, and you're going to hear a lot about this today, is that costs need to go down. The industry does not support $100 break-even prices in the current environment in the short to medium term. So here you see our upstream capital cost index from IHS Sarah. And what you see is that last time we had a drop in costs was back in 2009. But there are two main differences this time around. One, we believe that oil prices is going to stay lower for a longer period than in 2009, where it kind of revamped fairly quickly. Secondly, last time cost reductions were supported by reduction in input prices on other commodities like steel, nickel, aluminum, copper, so on. This is not going to happen this time around. There's been some downward movement in those prices, but other industries requiring these resources are doing much better this time around than in 2009. So this cost reduction needs to come from elsewhere. And I think some of our speakers are going to talk about this later today. It will need to come from, from new technology, innovation, cost-saving technology, if you don't want your margins to hurt, right? So that's kind of a challenge to the industry. So back to my title, Stay Calm. So in this environment, we all need to reduce costs, right? so do what you need to remove unproductive resources. This is the time to do that. But you need to make sure you're capable of improving efficiencies and drive innovation. Make sure you, as our chairman here said, invest in your people and in the critical resources you have. Don't end up as in 2009, where the industry got rid of too much capacity. And then when things started to turn positive again, we ended up struggling to get the resources to keep up with activity. And what happened? Costs skyrocketed, right? That's going to happen again if we don't stay a bit calmer this time around. It's easy to get rid of resources in a downturn, but it's hard to get those resources when things start to improve, and it's also very costly. So with this in mind, let's look at the market that we care about, FPSOs. So last year, the operators in this room and around the world ordered 12 FPSOs, mainly from Africa, Brazil, and Indonesia. 2 weeks ago, we had our first FPSO order in 2015. So that was the Sankofa development in Ghana, where Eni ordered a leasing unit from Yunsun. And this is a bit interesting because most people expected MODEC to get this contract. This is the biggest FPSO Yunsun has done to date, but they have the relevant experience from the region, from previous projects in West Africa. And allegedly, they underbid MODEC quite significantly. But don't expect 12 orders in 2015. We are quite kind of negative on the outlook for 2015 with the current environment. And historically, you see that orders have moved with the oil price. Back in 2009, the number of orders dropped significantly. But operators, they typically tend to postpone FIDs in this environment. And there was not many projects that was cancelled. It was more put out in time. Petrobras was the only exception back then. They focused more on the long-term production targets and kept ordering FPSOs. But as you will see on the next slide, this may not help us in 2015. So 2015 will be weak, and we expect a low number of orders from Brazil, Africa, and Europe, and that's kind of what's driving it. Petrobras, who is historically our biggest buyer of FPSOs, they said publicly that their projects, the pre-salt projects, are economical at $50 a barrel. However, Petrobras is currently struggling with the corruption allegations, and that has led them to suspend 23 suppliers, and they're currently reviewing all their plans. And we do expect that they will have challenges taking on any new projects in 2015 in this environment. This will resolve eventually, and once that's done, they should be able, to get back to a normal pace of 2 to 3 at least per year to meet the production targets that Brazil has set for that company. Africa is going to be the largest source for new build developments in the forecast period. But many of the projects in Angola and Nigeria are high risk, high cost, deep water developments. And what we've seen in the past, when oil prices are softer, that typically delays projects. And we think that's going to happen in 2015 as well for the new builds. Projects that's likely going to move forward is lower cost projects for bigger fields. One example here is the Kamaya field in Angola, which is something that we believe could happen. If you look on the bright side, Asia Pacific may be a place where we'll see some orders in 2015. There's a chance that Chevron could move forward with their GHAM and Gendalo development in 2015. So this is part of the Indonesian deepwater development and is the second phase of this project, which involves 4 fields, the Gendalo, GHAM, the Maha, and the Jandang field. So this development will feed into the Bontang LNG facility. And if there's a delay in FID on this project this year, that could have quite significant impact on utilization rates on this LNG facility. And we don't believe that Pertamina in Indonesia would let that happen. What we will also see is that most of the FPSOs in 2015 and 16 is likely going to be leased units. Typically in a low price and a reduced spending budget environment, it favors the FPSO leasing concept. So leased FPSOs reduce capex for the operators prior to first oil, and also it enables phase developments of bigger fields. We saw that for Premier end of last year. They chose an FPSO concept instead of buying a TLP for their Sea Lion. So that was the demand side. Let's kind of turn to the supply side. So we're going to start off with the yards. So the new builds, as we know, are typically built in South Korea by the 3 major Korean yards, Samsung, Daewoo, Hyundai. And here we have plotted their delivery schedule for drilling rigs and floating production units. And as you will see, most of their units, big projects, will be delivered in 2015. So these guys are going to be hungry for new projects as they're going to use to have more orders in their books than what they're looking at right now. If we look at the Singaporean yards, the conversion yards, they're also a bit in a similar situation. They have their own specialized FPSO yards, so they're not that sensitive to the rig market movements. And they have ample room for new projects in the near future. Also here, Semco Marine has just added 4 new VLCC-sized dry docks. So there's room for more projects from Singapore. Then finally, let's look at the leasing contractors. So these guys are pretty busy. And as we will hear about later today, they're willing to work with the operators on lowering the cost for the developments. But the leasing contract has been a period where they have incurred quite significant losses on some unsustainable contracts that was made back in 2009 to 11. So you will hear them talk about being selective about projects and finding ways to make sure also they can make money on the projects in the future. For example, BW Offshore here was willing to accept no new orders in the period 2011 to 2013, while other players like Bumi Armada has been very aggressive in the market, and they have a record number of FPSOs under management at the moment under construction. But we do also expect them to slow down order intake in the short term. We see some of the players, adjusting to the new environment. SBM, they have expressed concerns about capacity and the market and announced 1,200 job cuts end of 2014, half of it being their own staff and half of them being contractors. So let's zoom in on Northern Europe and Africa. We're going to start off with looking at the North Sea and the players there. So this chart is a Marimekko chart. It shows the market size on the x-axis and the market share of the various players on the y-axis here. And in the North Sea, for the leasing players, TK is by far the biggest, followed by Blue Water and BB Offshore. And then we had Bumi Armada moving into the region as a new player with their Kraken project. On the new build side, it's dominated by the South Korean yards, and on the conversion yards is the Singaporean yards, while the cylindrical Sevan design is so far been built in China. So looking at the supply side in that market, you can say it's pretty consolidated. And the main reason for this is that the market is fairly small compared to other regions. On the operator side, it's much more fragmented, and you see both small and big players in the market. So looking at the prospects for new projects in the North Sea, we had our asset valuation team run the economics on the upcoming projects. And as you see here, all of the projects require $60 a barrel or more to go ahead. So we don't expect any new orders in the North Sea in 2015, but 1 to 2 per year after that, depending on how oil prices perform. So going to Africa. Looking at Africa is the biggest source of new build developments in our forecast period. And 70% of the FPSOs is in Angola and Nigeria. 46% of the FPSO projects have a break-even price of $70 or higher. So there will be a lot of focus on reducing costs on these developments before moving forward. Maersk Oil said for their Chisonga development, they have challenged with the project at $80. So they're currently working with the government and with the suppliers to reduce and make it sustainable. Also, the governments in Angola and Nigeria are pushing for more local content in the projects. And we have illustrated this on this next slide. So African new build FPSOs provide an example of how local content drives higher costs. New build FPSOs, as I mentioned, are typically built in South Korea and then deployed to the field. However, rising local content requirements are forcing operators to build more of the FPSO locally. So here's an example of 2 FPSOs back in 2008 that was built in South Korea, the Pass Floor in Angola and Usan in Nigeria. But then, for Total's Egina project, they had to accept 45% of the FPSO to be built locally in Nigeria. And Samsung Heavy Industries, who's the yard supplying the FPSO, they are incurring a lot of additional costs for this project, which includes redeveloping the lateral yard in Nigeria, as well as bringing in managers to train the local staff. And the extra cost has resulted in the Egina project being 40% more expensive than similar projects in West Africa. And this is after adjusting for price inflation, as well as the size of the FPSO. So what's the opportunity here? Well, FPSO contractors like SBM, DSME, Samsung, and Saipem, who have joint venture arrangements and yards in West Africa, in Nigeria and Angola, they're probably better placed for some of these upcoming projects than some of the others who don't. Looking at the prospects for projects in Africa, you see here our adjusted forecast, the blue line. So back in 2013 and 14, we had a couple of pretty good years for FPSOs and orders in Africa. But we do expect for 2015 and 16 in the current kind of oil price environment that it's going to be a bit slower. And then, if our forecast for oil materialize, and also we see impact of the cost reductions, then we should be able to move up to around 4 FPSOs per year from 2017 and onwards. So let's conclude. And I hate being the carrier of bad news, but we need to be realistic, right? So the current low oil price environment, that is going to have impact on what the operator is going to do this year. They're focusing on reducing spend and focus on reducing costs, and it doesn't have impact of the number of FIDs in 2015. Brent oil prices are going to average below $70 a barrel over the next 2 years. And do expect in this environment, significant write-downs, job cuts, also project delays and strategy reviews, and we also expect a bit of M&A activity in the environment. So even for robust FPSO projects, this environment typically will delay the decision process. We do expect a dramatic drop in number of orders in 2015. So and the low oil price environment typically favors FPSO leasing rather than new builds, as it requires less capex upfront for the operators. Many of the North Sea FPSO projects, as we saw, are not economical at below $60, or all of them. So we don't expect any orders for the North Sea in 2015, but from 2016 onwards, there may be 1 or 2 per year. So, as I said, stay calm, do what you need to do to improve efficiencies and to reduce costs. But learn from the previous cycle and make sure you have the right capacity when things start to turn around. For those who now invest in technology and keep the right crew through these challenging times, will be in better position when things start picking up again in a few years. And with that, I conclude my presentation. Any questions?
JP, thank you very much indeed. We have time for a couple of questions, so if you'd have questions from the audience. Gosh, you're all stunned into silence.
We're busy selling our stocks.
Yeah. Yes, thank you.
Sorry. Hello?
I can hear you.
Okay.
Yep.
One question, you noted that in the current environment, new FPSOs are likely to be on a lease basis. With access to capital markets far harder due to current circumstances, how do you conclude that contractors can get access to capital to go forward on a lease basis?
And that's a good question. I think in the current environment, the operators and the contractors, I think they need to find ways to kind of move forward with the projects that's economical. And for the smaller operators, they also face some of the same challenges, right? And there's a number of them who don't have a lot of cash flow kind of coming in. So they're facing some of the same challenges. I think the operators and the contractors, they will need to kind of work together on solving this. It's not one-sided in the market. Yeah.
Mike.
Mike Wiley from SBM. Just to answer that question, I mean, we've just successfully financed a $1.7 billion FPSO. No particular issues on the market at the moment to get that financing on solid projects.
So there you go.
And so the client is.
Okay, any more questions? Yes, one more question there, and then we must move on.
Thank you very much for a very interesting presentation. My question is really, we're lumping FPSO into one column. I mean, surely there must be huge FPSO with huge capacity like the one on the Scar field, and maybe an emerging market of more nimble smaller and more efficient and cheaper FPSOs for marginal fields, which is really what we're looking at in the North Sea at the moment. Could you elaborate a bit on that, please?
Yeah, I think I'm going to leave that to some of the guys coming after me, because I'm sure they're going to talk about this. But I think you're right. I mean, you will have some of the big FPSOs in West Africa and Brazil, right? But in this market, you will need those units which are cost efficient and flexible. So that's the challenge, I think. To not just to the contractors but also to the operators. They need to figure out this together. It's not one-sided. So.
I think that would be a really good question to raise again when we have the panel discussion as to how you see the market developing and perhaps what sort of segmentation in the market and any disruptive technologies that we might see emerging.
Yeah. Okay.
Okay.
Thanks.
JP, thank you very much. Thank you.